Hi, this is Zach Smith, your local friendly mortgage guy. So, we're living in a dynamic market right now. So, I just thought I'd share a quick video about assumable loans. I think that we're going to start hearing a lot about this. So, I just want to make sure that the agents that I work with and some of my referral partners understand exactly what they're getting themselves into when they do look at trying to do an assumable loan and things of that nature, because it's going to be a big hot button. I think as long as rates stay high and we have these loans that we've been doing at 2% for the last year, 2 years, we're going to see a lot of people asking about, I want to assume this loan, and listings, advertising assumable loans and things like that. So just wanted to dive into it here so that you could have a little bit of education piece to find out if this is going to be the right fit for my clients. Is it going to be the right fit for this listing I just took on? Things of that nature. So let's go ahead, dive right into it here. Let me share my screen here. Okay, so this is a little presentation that I put together here. You are sharing screen sharing. Okay, great. Got to make sure I got all this correct here for everyone. So my name is Zach Smith, local friendly mortgage guy. Own Chariot Financial. We do a lot of stuff, a lot of investor loans, builder financing, reverse mortgages. We do a lot of this stuff, down payment assistance. In fact, we have a down payment assistance class coming up on the 26th next week. So I'll also put that in the email here. So assumable loans. We're going to start hearing this, and people are going to start wondering, okay, well, what is an assumable loan? What can I do? How does it benefit my clients? Your clients are going to start hearing about it, things like that. So what is an assumable loan, and why are we talking about this? Well, we're talking about this because rates are in the sevens in some cases right now. So people are, why would you want to pay more for the same product? I mean, if you can get money at a cheaper rate, there's also other benefits to assuming a loan. Why wouldn't you want to do it? So that's what this video is going to discuss. An assumable mortgage provides a buyer the opportunity to purchase a home by taking over the seller's mortgage loan. So one reason buyers decide to buy a home with an assumable mortgage is to take advantage of financing with a lower interest rate if rates have risen since the seller originally purchased the home. So just to kind of back up a little bit. So basically what people are doing with an assumable loan is they're taking on the financing that is currently on the house. So let's say you have a $600,000 home, and there's a $500,000 note on that house. What the buyer is going to ask the servicer is, you have a $500,000 note on this home that I'm purchasing for $600,000. I want to assume that $500,000 note. I want to start making payments in place of the seller. So you're basically asking them to basically just start making payments instead of the seller. So you're assuming that debt and that responsibility. Now, by doing that, you also have to qualify. It's not like they're just going to, oh, okay, go for it. You still have to qualify all the normal things of the loan. And we'll go into a little bit more detail with that here in just a moment. But that's basically what it is you're assuming the debt that is on the current mortgage. So what types of loans are assumable? So assumable loans include government loans, FHA, which includes FHA, VA, and USDA loans. Now, interesting little tidbit about VA loans is that you don't need to be a veteran to assume a VA loan. I know that sounds a little strange, but you don't. You can assume a VA loan. So I know that VA financing has got a bad rap here in the last couple of years, and honestly, I don't know why. I think that a lot of agents, there's a sentiment that there's two things that are working against VA offers. One, that the person is not putting any money down or not required to put any money down, doesn't mean that they don't have to. For instance, doesn't mean that they can't, is what I mean. For instance, they may have enough money to buy the house cash, but they want to stay a little more liquid, so they're going to leverage their real estate. And why wouldn't you these last couple of years at 2% interest rate? Why wouldn't you leverage an entire loan amount for that amount, stay liquid, and that way you can direct your money wherever you want to direct it. And these days, you probably want to go into safer investments and things like that. So a VA loan is assumable. You don't have to be a veteran to assume it. Also, conventional ARMs are generally assumable. Now, conventional, the fixed rates are not assumable, but the ARMs in many cases are. But you definitely want to be careful, if you're getting into a 5-year ARM, they've had it for 3 years, you're basically putting yourself into a position where you're assuming an ARM that's going to start adjusting in 2 years. It's kind of like the buy downs. I did a video about the buy downs a few weeks ago, and everybody's, oh, buy down, buy down, buy down. That's how we're going to do it. Folks, let's pump the brakes a little bit. I know that people want to get into these homes, but a buy down is going to increase their interest rate by 2 points over the next 2 years. And I know the sentiment is you don't have to marry your mortgage, you can just refinance. Boy, did I hear that. Oh my gosh, deja vu all over again. I think I heard that a lot in 2007. Get into a 228 and then, oh, you don't have to marry your mortgage. You just refinance afterwards. So I see some of these things happening, and I just want to bring it to light. But to get back to the assumable loan situation, conventional ARMs and government loans. So FHA, VA, USDA, and conventional ARMs. So what are some of the pros and cons of assumable loans? If you assume a note, why are you doing it? So what are the pros? Well, you definitely want to do it if you have an interest rate that's in the 2s. I mean, my gosh, if you can get 5 points under what they're currently going for right now, why wouldn't you do that? The other thing that people may or may not talk about assumable loans is that you may purchase or assume this note. Let's say they've had the note for 5 years. Well, you may assume that note 5 years into that amortization schedule. The longer you're in that loan, the more principal you're paying back. So for instance, if you had somebody who had a $200,000 balance on their mortgage and they're at a 7% rate, but they've been in the note for 20 years, we'll just say, or you have someone who's going to refinance that same $200,000, but they've only been in the note for a year, and they're going to bring their rate down to say like 3.5 or something like that. So it's a big difference in the interest rate. It still may not be the best option to go with a lower rate. And I know that sounds silly because you're going to be paying less money per month, but you're starting that amortization all over again. So if you're 20 years into that note or 15, you probably don't want to do anything with that note, even if you're at a higher rate, because you're paying so much principal. You're aggressively paying that principal off. So just something to kind of throw in there as well. So that is one of the benefits of assuming a loan, is that you're going to have a little bit of that upfront amortization taken care of up front. So what are the cons? Sounds great, right? Why wouldn't you assume every loan should be assumed, right? 2% interest rate, just go for it. Well, what are the cons? Well, borrowers still need to qualify for financing. So they're not just going to say, hey, okay, start making the payments. They want you to qualify for it. Secondly, borrower would have to work with servicers and not a loan officer. This is kind of like, the hidden costs, kind of like these builders in the metro districts. There's hidden costs here that are going to affect your transaction. Now, I don't know. I'm just making an assumption based on my experience. And a lot of that experience has been drawn with, 2008 and other people who have looked for forbearances and things like that through a servicer. It's not always a cut and dry process working with a servicer. For instance, in 2008, the bank, people were in trouble. They were losing their jobs. So the bank said, you know what, we want to help you. We want to do everything that we can to help you stay in your home. You had a record number of foreclosures back then, but that was their pitch. So what they do, they said, okay, well, here's this big stack of paperwork we want you to send in to us. Go ahead, send that in to us, and we'll get things looked through, and we'll set up a modification for you or try to keep you in your home. Well, people would get this big package of information sent into the servicers, and it would just go to a black hole. The right hand did not know what the left hand was doing. It was a very difficult and tumultuous process. So if you're getting ready to list a property and say, oh, hey, the loan's assumable, all that stuff, just know that you may want to build in a 45 or 60-day close time, because working with the servicers is not like working with a broker where you can, people call me up on a Saturday afternoon and I'll answer. Well, some of the servicers are not exactly built that way. You're going into the call system, and boy, those call systems, it's like, I just want to talk to a human sometimes, So anyways, just keep that in mind. If you do assume a loan, you're going to be working with the servicers. Also, I mentioned that you don't have to be a veteran to assume a VA loan, but it's not exactly the best thing for the veteran, because the veteran will lose a large portion of his or her eligibility if you assume that loan, because their eligibility is tied to that financing. So if they want to go out and purchase, they can still purchase with a VA loan. You can have more than one VA loan under your eligibility, but the 100% financing, the entire entitlement, is going to be disrupted if they if somebody assumes that loan, whether they're a veteran or not, because the veteran's entitlement is going to be tied to that note. So just kind of keep that in mind. Well, I hope this was helpful. I kind of, I'm looking at the writing on the wall. I see this being something that people are going to be talking about, and I feel like they're only going to be presenting one side. I want you guys to know everything. I want you to know the top, the bottom, the side. I want you to know everything about this situation before you get into it, so that it'll help your transactions go a little smoother. So anyways, feel free to call me anytime. I'm at your service. Have a great rest of your day.